There is a particular kind of financial stress that nobody really talks about, and it's one of the cruelest kinds, because from the outside, it looks like everything is fine. You've paid off your home, fully, not a dollar owing. The house is worth $600,000, maybe more. You've done everything right. You saved. You were careful. You didn't splash money around. And now, you're sitting in that house, in your 70s, and you're genuinely anxious about whether you can afford a new hot water system. You're putting off the dentist. You're choosing between the car registration and the council rates. You're lying awake doing arithmetic at 2 in the morning inside a property that would make most working Australians weep with envy. That is asset rich and cash poor, and it is the lived reality of hundreds of thousands of Australian retirees right now. Here is what almost none of them know. The Australian government runs a scheme, an official, legislated, government-administered scheme that lets you convert some of that locked-up home equity into a fortnightly income at an interest rate less than half what any bank would charge, with a legal guarantee built into the legislation that you can never owe more than the home is worth, without selling, without moving, and without making a single repayment for as long as you live there. A single self-funded retiree can access up to $46,000 a year through it. A couple can access close to $68,000 between them. Fewer than 19,000 Australians are currently using it. The government's own figures suggest more than 4 million are eligible. That means around 96% of the people this scheme was built for have never touched it. Most have never heard its name. The scheme is called the Home Equity Access Scheme, and this video is going to tell you exactly how it works, who it genuinely suits, who it can seriously hurt if they don't understand what they're agreeing to, and what 3 specific steps are worth taking this month, if any of this sounds like your situation. I spent close to 3 decades inside the Australian Public Service. A significant stretch of that was at the Department of Social Security, and later Centrelink, working on the pension system and the schemes that sit alongside it, including the one that was then called the Pension Loans Scheme, and is now the Home Equity Access Scheme. Since I retired, I've been running free community information sessions and volunteering with the Financial Information Service. I need to be straight with you before we go further. I am not a financial planner. I'm not a solicitor. I'm not a licensed advisor. Everything I'm about to tell you is general information based on my professional experience. It is not personal financial advice. Before making any decision about this scheme or any other financial product, please speak with a registered financial planner. And please book a free appointment with a Services Australia Financial Information Service officer. That appointment costs you nothing. And I'll give you the number at the end. Right, let's get into it. The Home Equity Access Scheme is a voluntary loan from the Australian federal government, secured against property you own in Australia. It is, in plain terms, the government's own reverse mortgage. But unlike a bank reverse mortgage, it operates under specific consumer protections written into legislation. It carries an interest rate set well below commercial equivalents, and it includes a no negative equity guarantee that the private market simply cannot match to be eligible. You need to be of pension age, currently 67 or older. You need to own real estate in Australia. The property doesn't have to be fully paid off, but if there's an existing mortgage, that affects your available equity and therefore your borrowing capacity. You apply through Services Australia, the same agency that administers the age pension, and you manage everything through your MyGov account. Once approved, the government pays you money. You can receive it as a fortnightly payment, as a lump sum advance, or as a combination of both. You don't make repayments while you're alive and living in the home, unless you actively choose to. The loan balance, what you've drawn plus the interest that is accumulated, is repaid when the home is eventually sold, or from your estate after you pass away. Now let's talk about where the $46,000 figure actually comes from. The scheme sets your maximum fortnightly entitlement at 150% of the maximum age pension rate. That ceiling applies regardless of how much pension you actually receive. If you're on the full age pension, you can borrow an additional 50% of that rate on top of your pension. If you're on a part pension, you can borrow the gap between your pension and the 150% ceiling. And if you're a self-funded retiree receiving no pension at all, you can borrow the entire 150% as a loan. At the rates effective from the 20th of March 2026, the maximum single-age pension rate is $1,200.90 a fortnight. 150% of that is $1,801.35 a fortnight. Across a full year, that is $46,835. That is a real number. It is not a headline trick. A single self-funded retiree with sufficient home equity genuinely can access close to $47,000 a year from this scheme. For a couple, working off the combined couple rate, the ceiling sits somewhere near $68,000 a year between them. Now let's talk about the interest rate, because this is where the government scheme becomes genuinely different from anything a bank will offer you. The current interest rate on the Home Equity Access Scheme is 3.95% per year, compounding fortnightly on whatever balance you have drawn. Private reverse mortgages from Australian banks and specialist lenders have been sitting somewhere between 8 and 9%. The government scheme is right now roughly less than half the cost of the commercial equivalent. On a loan that compounds across the remaining years of your life, that difference is not marginal. It is the difference between a manageable debt and one that consumes the bulk of what you intended to leave behind. And then there is the no negative equity guarantee. This is the protection most people don't know exists, and it is the one that matters most emotionally. For retirees who are frightened about reverse mortgages, the guarantee means this: you, your surviving partner, or your estate will never be required to repay more than the market value of the property at the time of sale, even if the accumulated loan balance has grown larger than the home is worth by that point. If the loan balance reaches $350,000 and the house sells for $280,000, the estate repays $280,000 and the remaining $70,000 is written off by the government. That shortfall cannot be recovered from any other part of your estate. That guarantee eliminates the nightmare scenario that haunts most retirees. When they hear the words reverse mortgage, the image of the debt eventually exceeding the house and leaving their children financially exposed. Under this scheme, that cannot legally happen. Now, here is the half of the story that nobody leads with, and leaving it out is a serious disservice to anyone trying to make an actual decision. This is a loan. It is not a payment. It is not a grant. It is not money the government is giving you because you've paid your taxes and earned it. It is money the government is lending you, and it accumulates compound interest every fortnight, and it must be repaid. Let me give you a concrete example of what compounding actually does over time, because the mathematics surprises most people when they see it written down. Take a single self-funded retiree, age 70, living in a home worth around $1 million. She decides to draw $800 a fortnight through the scheme, well below the maximum, a modest top-up to make life more comfortable. Over 15 years, she receives somewhere around $312,000 in loan payments, but the amount owing after 15 years is not $312,000. Because of compound interest at the current scheme rate, the balance is closer to $430,000 or beyond, depending on draw patterns. The gap, more than $100,000, is the compounded interest, and that interest does not come from nowhere. It comes from the equity in the home, which means it reduces what the estate receives when the home eventually sells, which means it reduces what passes to whoever she intended to benefit. That is not a reason never to use the scheme. For many retirees, it is entirely the right trade-off, but it has to be a conscious trade-off, made with open eyes and real numbers, not a decision made on the basis of a headline. So who does this scheme actually suit, and who does it not suit? In the sessions I run, I see two immediate reactions when people hear about this scheme. The first group says, absolutely not, I'm not putting debt on my home. End of discussion. The second group says, this solves everything. Where do I sign? In my experience, both reactions arrive too quickly. Three things determine whether this scheme is right for you, and they're worth thinking through carefully. The first is your time horizon and your health. The compounding on this loan is not catastrophic if the loan doesn't have decades to run. A retiree in their late 70s or 80s, drawing a modest fortnightly top-up to live more comfortably in their remaining years, accumulates relatively manageable interest across a shorter period. A retiree in their late 60s, drawing the maximum for 25 or 30 years, is a completely different mathematical reality. Your age, your health, and your honest assessment of how long the loan is likely to run should shape every decision you make about how much to draw. The second is what your family actually wants. This is the conversation most retirees avoid, and the one that matters most. Many parents carry a quiet, unexamined belief that preserving the family home to pass on intact is a fundamental obligation, and many adult children carry an equally unexamined wish that their parents would spend their own money, live comfortably, and stop worrying about the inheritance. These two assumptions sit in the same family for years, sometimes decades, without ever being spoken aloud. The Home Equity Access Scheme forces that conversation into the open. I have sat with families where adult children, once they understood the full picture, were genuinely upset that their parent had been going without for years in order to preserve something the children didn't even want preserved. Have the conversation before you make the decision. Don't assume you know what your family wants. You may be wrong, and it may be costing you years of unnecessary stress. The third is the pension and concession card interaction. And this is where a quiet quirk in the scheme catches people off guard. The fortnightly loan payments are not assessed as income for age pension purposes. Participating in the scheme does not by itself reduce your pension. However, if you take a lump sum advance, and that money sits in your bank account beyond 90 days without being spent, it becomes an assessable financial asset, which can affect a part pensioner's payment rate. More importantly, for self-funded retirees, drawing from the Home Equity Access Scheme does not on its own qualify a self-funded retiree for the pensioner concession card. That card is worth real money, cheaper medications, reduced council rates, various state concessions. If access to the concession card is part of why you're considering this scheme, get specific advice on that point before you proceed. Now let's talk about 3 steps worth taking this month. If you own your home, you are of pension age, and you've been lying awake doing financial arithmetic when you shouldn't have to be, here is what I'd suggest doing in the next few weeks. Step 1. Use the official calculator. Services Australia has a Home Equity Access Scheme calculator. Accessible through Centrelink online via MyGov, it will give you a personalised estimate of your maximum fortnightly entitlement, your current home equity position, and the projected loan balance at various points in time. It is free, it is official, and it is the single most useful starting point. Search Home Equity Access Scheme Calculator on the Services Australia website. Step 2. Model the compounding before you draw anything. The question is never simply how much can I access. The right question is, given my age, my property value, my health, and my intentions for the estate, how much should I draw? And what will the accumulated balance look like at various points? A registered financial planner can run those numbers for your specific situation. It is exactly the kind of calculation that requires someone who can see your actual figures, rather than a general estimate. Step 3. Book a free appointment with the Services Australia Financial Information Service. These officers are not financial planners. They will not tell you whether to apply, but they will explain precisely how the scheme applies to your individual circumstances, how it interacts with any pension you currently receive or might receive in the future, what the concession card position is for you specifically, and what the repayment implications look like. They do this for free, and they deal with the Home Equity Access Scheme constantly. The number to call is 132 300. Say that again. 132 300. Ask for a financial information service appointment. You can do it in person or over the phone. Now I want to close with something that has nothing to do with interest rates or fortnightly calculations. The retirees I sit with who are asset rich and cash poor are not in that position because they made bad decisions. They are in that position because they made good decisions their whole lives. They bought a home. They paid it off. They saved carefully. And then they hit a stage of life where the assets they accumulated are in a form they can't access without dismantling the life they built. The financial stress those people carry is real. It affects their health. It affects their relationships. It affects the quality of the years they have left. And in many cases, it is entirely unnecessary because there is a government-administered mechanism built specifically for their situation that they have simply never been told about. I don't have a satisfying explanation for why that gap in awareness exists. The scheme isn't hidden. It's on the Services Australia website. It was renamed and expanded in 2022 specifically to make it more accessible, and still, fewer than 19,000 people are using it, out of millions who qualify. If someone in your life owns their home, is of pension age, and is going without things they shouldn't have to go without, tell them this scheme exists, point them toward the calculator, and suggest they make that free phone call. That is usually enough to start something. The number 1, more time. 132,300. Ask for a financial information service appointment. It costs nothing, and it could change everything. General information only, not personal financial advice. Speak with a registered financial planner and a Services Australia Financial Information Service Officer before making any decisions. Rules and rates are subject to change.